The Honest Money podcast is brought to you by Prescient Investment Management. We consider everything to give you the advantage. It's the future of investing. Prescient Investment Management is an authorized FSP.
Welcome to Honest Money. I'm Warren Ingram. We're living in a slightly volatile time, and I'm using slightly with a bit of a smile because it's a rather volatile kind of state of play at the moment. World markets are being upended by the prospect of a trade war, which is being initiated by the USA. And the reason that they're doing that is they're trying to impose tariffs in the belief that they will find some way to balance trade in their favor, I guess. Now, I can't think of a single globally respected economist who thinks that tariffs are a good idea, but we're not talking about tariffs today and whether they're good or bad, because that's an economic lesson which will put us all to sleep. What we are going to do is just talk about how one navigates that, and I think it is a difficult time to try and navigate investments in a time like this. And certainly, I don't feel we can always do it on our own. So I'm very glad to be joined by Bastian Teichgreeber. He's the Chief Investment Officer at Prescient Investment Management. Bastian, thanks so much for joining us.
Thanks for having me on, Warren. Thank you.
Bastian, to kick off, just to say, I don't think either of us are in the, and I do use the word game correctly here, in the game of predicting, because what we all know for certainty is we don't have a clue what's going to happen in the next day or week or month. Especially when markets are responding to an incredibly volatile, changing environment in the US, where a president can make a statement on one day and reverse course the next. So we're not talking today about predicting or trying to forecast where we think the world's going to go. I think what is important is to try and help us, let's say, develop some sensible strategies for making as rational decisions as we possibly can when the world is seemingly crazy. And it's not just everywhere else, it's inside our country as well. Politicians are kind of doing their best to upend our domestic situation. How do we think about this stuff? What do we do in a time like this?
Yeah, Warren, I think you're making a good point. It's a lot of craziness out there, and it's very difficult to make sense of it and to develop a strategy which is robust and basically survives such big moves with ease. But we do think that, first of all, start with a diversified portfolio. First of all, start with having big exposures to all the asset classes, being it locally, being it globally. Don't be concentrated on any individual reason. Don't be concentrated on any individual currency. Yes, we've seen, for example, the rand going particularly weak, but now it's the dollar which is going particularly weak. Who would have thought that? So diversify your portfolio, and then cut through the noise and cut through the headlines and focus on the things you can actually measure. Because we don't know what the next tariff is going to be or not, but there are measurable things. Like we can measure asset class valuations, we can measure the impact on confidence, business confidence, consumer confidence, investor confidence. And with that, we have this long-term diversified portfolio, and we can alter it into asset classes which are looking more promising than others.
So I think a couple of points to touch on there. The first is, when you're looking at a state of world that we're in now, number one, because you can't predict what none of us can. I mean, it's just it's a fool's game, I think, to try and predict where things are going to go. The one measurable is you can look at, let's just say, the value of the stock market. You can say, I don't know where the US stock market's going to go tomorrow or next year. But what I can do is I can look at the US market, I can look at the European markets, maybe just the global markets. And if the market, the volatility has driven those prices of those shares down far enough, there will be a point when they are good value. And that's something you can measure. That helps you to start making a sensible decision about, maybe for whatever reason you've been very low on global shares, and you're wondering about whether you should be rebalancing your own portfolio. The point here is you can start with valuations as a measuring point. It is a true north and the compass of investments.
That's exactly right. And I will use equities as an example, but then I also tilt to bonds and the currency. But if we look into the equity market, one of the most often used valuation metrics would be your price to earnings ratio. So you literally just divide the price which you have to pay for an index or an individual stock. We like to focus on indices. So if you focus on the index, how much earnings in terms of index points do you have to pay to own the index, right? And obviously the less earnings points you have to pay, the cheaper the index, right? And if we apply this measure, we get like a long-term, as you call it, Warren, true north in terms of like how the asset class is valued. Looking into the US market using that example, we can measure that the market remains very expensive. So with that, we can draw first conclusions from a pure valuation point of view. There could be more downside. The asset class is still not cheap, right? If we swing it over now basically towards South Africa, the story changes a little bit, right? So our share market is actually quite attractively valued, certainly more attractive than other comparative asset classes or other equity markets. So with that, we can start to have that first view. Also like linking this to the bond market. In the bond market, we can bring in inflation and we can measure what is a real yield, like how attractively priced is our bond market against inflation. And there we can measure that the bond market in South Africa is also very, very attractive. You're earning a yield of 12 and inflation right now is at 3. So that's very attractive and leaves room for bonds to rally. And last but not least, in that context, let's also look at the currency. Here we can apply the long-term concept of purchasing power parity. So basically looking, if you adjust for inflation and then you look into the long term, how more expensive are goods in the United States than in South Africa. And there you can once again back out that our currency is quite undervalued. Okay, so that's just a starting point. There's way more to it, but these are good starting points to assess whether an asset class is expensive or cheap.
So I mean, just kind of very simplistically, if we were looking at the state of the world and we said, okay, when you want to make an investment decision, you would look at, let's just say on an index level, for argument's sake, I mean, it could change by the hour, but America makes up 60% of the world stock market, and all the other countries get to the other 40% in various ratios. When you're making an investment decision, you would start with the valuation of the US to say, okay, it's at 60%, and as you said, it's still expensive. So as an investment, decision maker, I'm not going to overweight America. In other words, I'm not going to go from 60% to 70% because the starting valuation to buy into that is expensive. So what you might do is, if you can't see better value elsewhere in the world, then you might say, well, I'm going to go at least to the 60%, or I can see better markets with better value elsewhere. So I'm not going to be at 60%. I'm going to be at 55 or 50 or whatever the argument is. And that's not based on you saying, I've checked my crystal ball, I've read the Wall Street Journal, America's going to be fantastic or America's going to be awful. It's saying valuations are a form of gravity. And if valuations are very high, gravity is going to drag the future growth down. If valuations are very low, the prospect is that the future growth should be good. Not a guarantee, but it's a very nice starting indicator. And then you're doing that, if I understand correctly, doing that across the bond market. I guess cash at points in time. There are very few times when actually cash gives you a very nice return above inflation, but it's a very short period of time. So I wouldn't be a long-term holder of cash, but there might be those things. And then maybe just to talk about real yields for a second. And I think it's a very misunderstood or not well kind of tracked thing, but there are times, and I'm actually surprised by how good that yield is at the moment. So you can buy South African bonds and they're going to pay you an income of 12% a year. And at the same time, our cost of living is going up at 3% a year as a broad nation, not your particular cost of living or my particular cost of living, but as a country. And that means our money is growing at 9% a year faster than the cost of living. So that's the real yield. I mean, there can't be many places in the world where you can get that kind of a growth rate on government bonds above the cost of living.
That's exactly right, Warren. It's particularly attractively priced here in South Africa when we look into the government bonds. And I guess all the other evaluation metrics point us in the same direction, that the South African capital market is actually quite attractively priced. And as you said, that's then your starting point, and then we would overweight more South African assets compared to global assets. But we obviously have to look one step further, and we like to augment these valuation metrics by different factors. Like that's why we also look into financial conditions, into the economic picture, into market sentiment, and to your point, it's very hard to predict what the future holds, but we can actually measure what's happening in real time if we use a lot of data points, maybe even alternative data which we can draw. And as such, we use a lot of surveys into business confidence or into consumer confidence or into investor confidence. And those surveys tell us in real time that what's going on right now in the United States with the tariffs on and off, on and off, on and off, that takes a toll on confidence because businesses don't know what to do. And the consumer rather postpones consumption and saves up a little bit just to play it safe. And that's immediately when the US economy takes a knock. And that's one other factor which we would then use and basically augment those valuation metrics which I highlighted before.
And Bastian, at the time of recording, we still haven't got a kind of completed set of laws that make up the budget in South Africa. So we're living at a time where there's an elevated level of uncertainty, and it's new for us because in this country, budgets have always just been passed by a ruling party, and this is the first one where there's real negotiation and real contestation. Now, we're not in the game of predicting, but as you were saying, you're looking at valuations. Bonds look very good. The local market looks very good, and we're talking about valuations. How do you then look at all of the political uncertainty and then have the guts to say, yes, we're buying? Is the temptation, kind of playing devil's advocate, but the temptation just to sit on the sidelines and earn a rate of interest and watch all this unfold? Is that not a better course of action than buying shares which might be affected by politics again?
Well, following your cognitive biases and being tempted into making decisions, I guess when it comes to investments, is never a good strategy. So sometimes it is good to sit on the sidelines, but we do think that we have to always look at the data and actually form a view, and that's what we're doing. So speaking about the political events which you just mentioned, we can measure how much they really impact markets. We can measure that through how much money is flowing into the countries from foreigners. Is there, like if you survey foreigners, have they lost confidence from an investor's point of view to invest into the South African capital market? So even there, you can eliminate your biases. Instead of looking at the headlines and really making sense of the politics and whether the GNU is falling apart or not, we don't do that. But what we can do is measure the data points around this, and that can surely impact our decision making, right? So through this whole GNU story, we could track that investors' confidence has dropped a little bit, and with that there's less money flowing into South Africa, and with that there's a little bit of a negative impact on our bond market and our currency. Having said that, always speaking about the local things, I need to put out a big disclaimer. The bigger picture, the global developments are mostly overshadowing these, not necessarily in the headlines, but in terms of what's really driving capital markets, and that's something we observe right now. So the tariff story is actually way more important right now than the GNU story and the VAT hiking story.
Yeah, and I think it's such a powerful point. We're because we've got such a free press, such an open economy. We often think that all of these issues are our own, and whatever's going on in South Africa is affecting the rand, and that's the biggest driver of why the rand gets better or worse is South African politics, and I think it's just not true. In most instances, the rand moves dramatically by events from outside of South Africa. There are times when local events will move the rand in a direction, but most of the time, if the rand moves by 30 cents to the dollar in a day, that's global stuff, and it might move by 2 or 3 cents to the dollar because of local stuff, and sometimes they don't move in the same direction at the same time. So the rand might weaken even though we get good political news in South Africa, and the other way around. I remember, I think the rand strengthened on the day when Jacob Zuma was announced as the president of the ANC, and I can remember clearly thinking no one decided that was an economic good for the country, but the reality was there was global news that was positive that far outweighed what was going on. So I think you make a very good, strong point there. So when you're looking at the state of the world now, and the political news in South Africa is loud, but way louder outside of our country's borders, and you're looking at the rand, and as you say, it might blow out to nearly 20 to the dollar, and then kind of trickles back gradually. I think there's the prospect that you could be looking at the rand at below 19 to the dollar again, and you're trying to make a 5 or 10 year decision. I mean, do you look at the rand at 20 to the dollar and say, gee, that looks expensive, I'm going to sell some dollars and buy some rands, or is that sort of a trading position and then you avoid that? I mean, where does valuation count when you're looking at currency?
Yeah, the same way, Warren. So we always start with valuations, because I think I like that example you made earlier about the true north, and it does work on the currency side as well. Like the two valuation metrics we would use on the currency side is, the first one as an example would be just the purchasing power parity adjusted price. So we adjust for how much inflation did we have in the States, how much inflation has there been in South Africa, and then we see where were prices comparatively 5, 10, 15 years ago, and then we can draw conclusions whether our currency has depreciated more than it actually should, and if, then it is cheap, right? Another good valuation metric would be to look into interest rate differentials, like how much more interest rates can I draw in South Africa by owning, for example, the government bond compared to owning a government bond in the United States. And once again, we would look at the real rate, so take out inflation just to make it more comparable. And to just give you those numbers, I mean, as you mentioned earlier, 12% on a government bond in South Africa, minus 3% inflation, which means you are outgrowing inflation by 9% if you invest in the rand-denominated government bond in South Africa. If you look into the States, we've got roughly 3% inflation, similar to South Africa, but our 10-year government bonds gives us 4%, right? So that's like a whopping 8% less, right? So that means clearly that our asset classes are cheaper valued. They are cheaper valued for a reason. I will take that. But that gap is quite wide right now. So that once again on the currency means a lot of undervalued asset classes, and with that a very undervalued currency. So it's again using valuations, different valuation metrics for different asset classes, augmented with financial conditions, economics, and market sentiment, and then you can form a systematic view on with a lot of different data points on the currencies as well. So yeah, at 20, or to answer that question straight away, we do think the rand is quite a bit undervalued, and we do think rather sell your dollars, buy your rands. The rand is going to strengthen from here. Famous last words, because we're not in that prediction game either.
Yeah, and I think that, I mean, a couple of really powerful points there. One, even in that situation, if we were talking about a big balanced portfolio, it's not as if you would go at 20 to the dollar, you would sell all of your dollars and convert all of that. It would be an incremental view. So I think that's also important for investors, is you can't be in the all or nothing game. If you think that American shares are expensive, that doesn't mean you go to zero exposure to the US market. That doesn't make sense. If you think the South African market is cheap, that doesn't mean you necessarily take 100% of all of your assets and allocate them to the JSE. Equally to the South African bond market, it might be tempting to say, well, it's great to lock in a 9% real yield on my money. The thing is, refer back to rule number one. We know we don't know what's going to happen. So having exposure and having diversification is hugely helpful there when life happens and events do the unthinkable, because that will happen. And I think you made the comment at the start of the recording, diversification is a huge help when the world is so uncertain. And then you bring up the systematic way of thinking and the systematic way of investing. And I think what's powerful about that for me is it allows you sometimes to be not purposefully contrarian, but it allows you to kind of remove yourself from the herd of markets to say, actually, according to my metrics and the way we work and our way of thinking, certain assets are incredibly cheap, irrespective of what the WhatsApp social media groups are saying and what the talking heads are screaming at us in the news. Valuations count, other metrics count, and according to this, we're going to be buying assets which some people are selling, and we're going to sell some of the assets which other people are buying. And it's because eventually that will deliver growth. So to me, it sounds a little bit, kind of helping you to protect yourself from yourself. We are human beings. We are going to get emotional. We can't help but, sit around the dinner table or around the braai with friends when they're all negative about life. It is going to impact us. And then we start work on Monday morning, and you have to find a rational way of making decisions. And that's where I'm putting words in your mouth, but that's where the systematic way of doing things comes in, is you develop a framework for making sensible decisions when the world doesn't seem so sensible.
That's exactly right. So you cut out those human biases, cognitive biases, emotional biases. We all have so many of those, and fear and greed are the most famous ones. And I mean, we know when markets fall, we all get fearful. And we know that markets rally, we always think, shouldn't we have even more exposure, right? So those are good examples. And as you rightly said, it's like protecting yourself from yourself, because our emotions are poor in decision-making aids. And the beauty of such a systematic process, which now uses a lot of data points, the beauty is that you can also test those strategies, right? We spoke a lot about valuation metrics and how we track the economy in real time through sentiment surveys, etc., etc. But who says that this stuff actually works? But if I always follow like a given rule set, right, then I can actually test those rules. So if I always invest when the stock market through my valuation metrics is cheap, does that actually give me better outcomes? And the answer is yes, we have tested those, and that's why we use those. For the price to earnings ratio, as I mentioned earlier, is a good predictor of future returns. It doesn't mean that it always works. It actually only works 60% of the time. But over the long term, if you keep on applying that systematic rule in a very disciplined way, you eliminate your biases around it, and you will eventually get 60% of the calls right, which then sets you apart from the pack. And it's good to go with these disciplines, because you can scientifically test those rules, and with that you're actually making investment decisions which are anchored in empirical evidence and which are not just gut feel or driven by which news you or I read today.
So Bastian, we're coming to the end of our show, and I just thought it would be a nice question to ask you. You're a chief investment officer of a business that manages a lot of money, and lots of people listening would be deeply unsettled now and very uncertain, and a bit like a ship in the sea with not much of an anchor or a sail or a rudder. How do you kind of give them a view to say, well, 5 years from now, without predicting, we're going to be okay because you follow a particular process, or we're okay because eventually markets do the right thing? I mean, how do people find calm in the storm?
Well, exactly. Now you're right, Warren. I mean, we always worry, right? As human beings, we always worried. And the reason being is we hate uncertainty. And markets are always uncertain. Times are always uncertain. They might feel particularly uncertain right now, but the reality is they're never certain. Like, the outcomes of financial markets are never easily known. So with that, again, just don't be fearful. Don't be greedy either. But look at the facts. And yes, we are not too optimistic on the global economy looking forward, given the policies of Donald Trump, and given that there's just so much added uncertainty and added fear added to the system. But having said that, we can also measure, as I said earlier, in a lot of examples, valuation metrics. And we do think, if you look 5 to 10 years out, as you said, we see that a lot of the asset classes, particularly in South Africa, are very, very attractively priced, right? So with that, I'm pretty sure that if you buy your SA equities, your SA bonds, and you hold the rand as a currency, that 5, 10 years down the line, you will actually have very, very good return.
I'm not going to ask you another question, because it's such a nice, positive way to end. And it's not a prediction. It's not a forecast. It's about measuring, making rational decisions, and then sticking out with those decisions as time goes on. Bastian Teichgreeber, Chief Investment Officer at Prescient Investment Management, thanks so much for joining us, and thanks for settling my nerves. At least I can go and have another coffee and just relax now.
Thanks, Warren. Thanks for being on your show.
The Honest Money podcast is brought to you by Prescient Investment Management. We consider everything to give you the advantage. It's the future of investing. Prescient Investment Management is an authorized FSP.